Hey everyone, Derrick here, senior trader at T3 Trading Group with your pro trading tip. If you've been liking these segments that we've been doing, make sure to hit the subscribe button for me, hit that like button for me. Today, we're gonna be talking about reward maximization through the trailing stop. A common mistake that I see and hear from people when I'm speaking to them is, yes, I implement a trailing stop system in order to try to maximize reward, but the way that I do it is I just choose a percentage amount or a random amount. So wherever the stock's high is, I'm constantly trailing it by 20 cents or 40 cents or half a percentage point or whatever it is. I really dislike doing things randomly with the market. That 20 cents or 40 cents or half a percent, that is a total random number. That might be important to you, but it's not important to the market. And making your trading decisions based on what the market is telling you is definitely key to success in any sort of chart analysis or technical analysis that you might be implementing into your trading. Another big problem that people have in general is that they don't even maximize their reward. As soon as they start to make a little bit of money, they hit out and they're never gonna be able to maximize the reward for the initial risk that they were putting on if they're not holding positions for a bigger move. The trailing stop is a really important way to be thinking about maximizing reward while also locking in profit. And again, like I said earlier, we don't want to do that randomly. So I have 3 major rules for trailing stops. Rule number 1, I trail based on pivot points. A pivot point is basically where a stock changes direction on the chart. The reason why pivot points are important is because a pivot point in the marketplace represents the exact price, the exact penny where buyers took control from sellers or sellers took control from buyers. So that makes pivot points technically important. So rule number 1, I trail based on pivots. Rule number 2 is what I call the equilibrium catch-up rule. And this rule is a little bit more complicated, but if you follow along with my trading, you know that I utilize an 8 and 21 EMA as key moving averages for my trading. And the reason why those are important to me is because the space between the 8 and 21 EMA for any chart that I'm looking at is the area for the chart that I consider to be the technical equilibrium for the time frame that I'm looking at. So if a stock has a really big up move, it moved far away from its 8 EMA, and then maybe it's coming back down and it creates a pivot point, I will only actually raise my stop to that pivot point if the price of it is at least the 8 EMA. Rule number 3, I need a new high to come in. What's the definition of an uptrend? An uptrend is a pattern of higher highs and higher lows. So if I'm implementing a trailing stop system in a stock that's moving higher and is trending in my favor, well, I've only actually confirmed that the pivot low from rule number 1 is the true pivot low of the uptrend after a new high actually comes into the stock. Once I have all 3 of those things, then I can actually raise my stop to the pivot. So again, we have pivot points, we have moving average catch-up or equilibrium catch-up as represented by the 8 EMA, and we have the new high coming in. All 3 of those things, check, 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 they're all there. I can now raise my stop to that last pivot point because the market told me that it was the right time. And by implementing a trailing stop system on multiple time frames, that's an excellent way for me to stick with a trade for the entirety of its trend, and that can help me to maximize my reward. Check out the links in the description below where you can learn about how you can become a part of my team of traders through the Pro Desk virtual trading floor, or that second link there goes to my ebook where you can learn about becoming a professional trader with T3 Trading Group.